What if I told you there's one investment vehicle that could capture the biggest wealth transfer of the next decade? While most investors are chasing individual stocks, the smart money is positioning itself differently. Today, I'm breaking down the ETF that's poised to absolutely dominate the 2030s. Title card up, the ETF set to dominate the 2030s. Stay with me. This moves fast and is packed with data. Let's dive straight in. Before we dive in, this is not financial advice. I'm sharing educational information and analysis. Always do your own research and consult with a licensed financial advisor before making any investment decisions. If you're serious about building wealth and staying ahead of market trends, smash that like button right now and subscribe for more deep dive investment analysis. Trust me, you'll want to catch every video we drop. The investment landscape is undergoing a seismic shift. We're not just talking about normal market cycles anymore. We're witnessing the convergence of multiple megatrends: artificial intelligence reshaping every industry, demographic shifts creating new consumer patterns, climate change forcing economic transformation, and technological innovation accelerating at an unprecedented pace. The ETFs that dominated the 2010s won't necessarily win the 2030s. Why? Because the game has changed. The winners of the next decade will be those who correctly identify which sectors, technologies, and economic forces will drive the future. Here's the question every investor asks: which forces will truly drive the next decade's winners? It's not one theme, it's their intersection. Think AI, genomics, clean energy, fintech, and automation converging at once. Up next, the megatrend convergence, and why it changes everything. Let me paint you a picture of what's happening right now. We're experiencing what I call the megatrend convergence, multiple powerful forces colliding at the same time. First, the AI revolution. We're not talking about science fiction anymore. Artificial intelligence is already transforming healthcare, finance, manufacturing, entertainment, and virtually every sector you can imagine. By 2030, AI is projected to contribute over $15 trillion to the global economy. Companies that integrate AI will thrive. Those that don't will become obsolete. Second, the great wealth transfer. Baby boomers are passing down an estimated $68 trillion to younger generations over the next 2 decades. But here's what's fascinating. Millennials and Gen Z invest completely differently than their parents. They want ESG, environmental, social, and governance, conscious investing. They want tech. They want innovation. They want to align their money with their values. Third, the green energy transition. Whether you believe in climate change or not is irrelevant. The money has already decided. Global investment in renewable energy infrastructure will exceed $10 trillion by 2030. Governments worldwide are mandating transitions. Corporations are setting net zero targets. This isn't a trend that's going to reverse. Fourth, the biotech boom. We're entering the golden age of biotechnology. CRISPR gene editing, personalized medicine, AI-driven drug discovery. The healthcare industry is being revolutionized. The pandemic showed us what's possible when we focus resources on biotech innovation. That acceleration isn't slowing down. Now here's the key insight. The ETF that will dominate isn't one that focuses on just one of these trends. It's the one that captures all of them simultaneously. Before we reveal the specific ETF, let's talk about why exchange-traded funds are the smartest way to play these megatrends. Instant diversification. When you buy an individual stock, you're making a single bet. If that company fumbles, maybe they have a scandal, lose a key contract, or their CEO quits, your investment tanks. With an ETF, you're buying dozens or even hundreds of companies at once. One company fails, you barely notice. Lower costs. Most ETFs have expense ratios under 0.5% annually. Compare that to actively managed mutual funds charging 1 to 2% or more. Over decades, those seemingly small differences compound into hundreds of thousands of dollars in savings. Superior liquidity. ETFs trade just like stocks throughout the day. You want in? You're in immediately at transparent market prices. You want out? Same thing. No waiting for end-of-day settlement like mutual funds. Tax efficiency. This is technical but important. ETFs have structural advantages that make them more tax efficient than mutual funds. You generally only pay capital gains when you sell, not when the fund manager rebalances. So we've got diversification, low costs, liquidity, and tax efficiency. Now let's talk about which ETF combines all these advantages with exposure to our megatrends. The ETF I believe is positioned to dominate the next decade is the ARK Innovation ETF, ticker symbol ARKK. Now, I know what some of you are thinking. Wait, didn't ARKK get crushed in 2022 and 2023? Absolutely it did, and that's exactly why this is the opportunity. Let me explain the strategy and why short-term pain could mean long-term dominance. What is ARKK? It's an actively managed ETF, focused exclusively on disruptive innovation. We're talking about companies developing technologies that could change the world. The fund focuses on 5 key innovation platforms. 1. Artificial intelligence and machine learning. 2. DNA sequencing and genomics. 3. Energy storage and electric vehicles. 4. Blockchain and digital assets. 5. Robotics and automation. Notice something. These align perfectly with our megatrends. This isn't coincidence. It's strategic positioning. Current major holdings include companies like Tesla, leading the EV revolution, Coinbase, cryptocurrency infrastructure, Roku, streaming entertainment platform, UiPath, robotic process automation, Teladoc, telehealth transformation, CRISPR therapeutics, gene editing pioneer. Here's the critical context. ARKK soared during 2020, gaining over 150% as innovation stocks rocketed during the pandemic. Then came the crash. From its peak in early 2021, ARKK fell over 75% by end of 2022. Why am I bullish now? 3 reasons. First, valuation reset. Those sky-high valuations from 2021, gone. Many of ARKK's holdings are now trading at reasonable multiples relative to their growth rates. The speculation has been wrung out. We're back to fundamentals. Second, interest rate environment. The Federal Reserve is done hiking rates. As rates stabilize and potentially decrease, growth stocks become more attractive. High interest rates hurt future cash flows. Lower rates help them. Simple math. Third, technology adoption acceleration. Here's what most people miss. Just because the stocks went down doesn't mean the technology stopped advancing. AI is being adopted faster than the internet was in the 1990s. Electric vehicles are hitting mainstream acceptance. Gene therapy is moving from experimental to standard treatment. The underlying innovations are working. Let's talk about market psychology for a moment. The best returns come from buying what's hated and selling what's loved. Right now, disruptive growth stocks are hated. After the 2022 bloodbath, most investors want nothing to do with innovation stocks. They've fled to boring, safe, dividend stocks and bonds. They've been burned. They're scared. And that's exactly when opportunities appear. Look at history. The tech crash of 2000-2002 was brutal. Amazon fell 95%, but those who bought Amazon in 2002 and held for a decade saw returns of over 4,000%. After the 2008 financial crisis, everyone said banks were dead. Those who bought financial stocks in 2009 doubled or tripled their money. We're in a similar setup. The weak hands have been shaken out of growth stocks. Valuations are reasonable, technology is advancing faster than ever, and nobody wants to own these companies. That's a contrarian's dream scenario. The risk factor. Let me be crystal clear. ARKK is volatile. If you can't stomach 20-30% drawdowns, this isn't for you. If you need this money in the next 2 to 3 years, this isn't for you. This is a long-term, high-conviction play for people who believe in technological disruption. Now, ARKK isn't the only ETF positioned for the next decade. Let me give you some alternatives based on different risk profiles. For lower risk, Vanguard Information Technology ETF, VGT. This tracks the tech sector broadly. Microsoft, Apple, Nvidia, Adobe. Less volatile than ARKK, but still captures technology growth. Expense ratio of just 0.10%. If you want tech exposure without the wild swings, VGT is solid. For green energy focus, iShares Global Clean Energy ETF, ICLN, pure play on solar, wind, battery technology, and renewable infrastructure. As the world transitions away from fossil fuels, this basket of companies benefits directly. For genomics exposure, Global X Genomics and Biotechnology ETF, GeneOM. If you believe the future is personalized medicine and gene therapy, this focuses specifically on those breakthroughs. Higher risk but enormous potential if the biotech revolution continues. For balanced tech growth, Invesco QQQ tracks the NASDAQ 100, the largest non-financial companies on NASDAQ. You get big tech like Amazon, Google, and Meta, plus smaller growth companies, more diversified than ARKK, less aggressive. Each of these plays the mega trends differently. ARKK is the most concentrated and aggressive bet on pure disruption. The others offer various levels of diversification and risk management. Alright, you're convinced that innovation ETFs deserve a place in your portfolio. Now let's talk strategy, because how you invest matters just as much as what you invest in. Strategy 1. Dollar cost averaging. Don't try to time the bottom. Instead, commit to investing a fixed amount every month, say $500 or $1,000, regardless of price. When prices are low, you buy more shares. When prices are high, you buy fewer. Over time, this averages out your cost basis and removes emotion from the equation. Strategy 2. Proper position sizing. Here's my general framework. If you're young with a long-time horizon and high risk tolerance, maybe 20-30% of your portfolio in a high-growth ETF like ARKK makes sense. If you're older or more conservative, maybe 5-10%. Never put all your eggs in one basket, no matter how much you believe in the thesis. Strategy 3. Quarterly rebalancing. Set a schedule. Every 3 months, review your portfolio. If ARKK has soared and now represents 40% instead of your target 25%, sell some and rebalance back. This forces you to sell high and buy low, which is the entire game. Strategy 4. Keep dry powder. Always maintain 3 to 6 months of expenses in cash or very safe investments. This prevents you from panic selling your growth positions during market crashes when you need money for emergencies. Strategy 5. Use tax-advantaged accounts. If possible, hold volatile growth ETFs in IRAs or 401ks where you won't owe taxes on gains until withdrawal. Save your taxable accounts for more tax-efficient investments like municipal bonds or index funds. Let's project forward and talk about what the next decade might actually look like for disruptive innovation. 2025-2027, AI integration everywhere. We're going to see AI assistants become as common as smartphones, not just chatbots, but AI that schedules your appointments, manages your finances, diagnoses diseases, drives your car. Companies that integrate AI will see productivity explosion. Those that don't will struggle to compete. 2026-2028, EV reaches tipping point. By 2027, electric vehicles will likely be cheaper than gas cars even before subsidies. Once that happens, adoption goes exponential. We're talking about the entire automotive supply chain being rebuilt. That's trillions in economic value being redistributed. 2027-2030, biotech breakthroughs go mainstream. The first wave of gene therapies are already approved. By 2030, treatments that once cost millions will cost thousands. Diseases we currently manage will be cured. The companies that own these therapies will print money. 2028-2032, energy infrastructure transformation. Governments worldwide are committed to carbon neutrality by 2050. That means the 2030s are peak build-out years. Solar farms, wind installations, battery storage, grid upgrades, trillions in infrastructure spending. 2030-2035, financial system evolution. Whether you love or hate crypto, blockchain technology is being integrated into traditional finance. Central bank digital currencies, tokenized assets, decentralized finance. The infrastructure is being built right now. Notice the pattern? Every megatrend we discussed is accelerating, not slowing. The companies positioned at the intersection of these trends will capture enormous value, and ETFs like ARKK give you exposure to dozens of them simultaneously. Let me tackle the most common objections I hear about investing in innovation ETFs. Objection 1. The best returns are already behind us. This assumes that technology stops advancing, which has never been true in human history. Yes, early internet investors made fortunes. But cloud computing came next, then mobile, then AI. There's always a next wave. The key is identifying it early. Objection 2. The expense ratio is too high. ARKK charges 0.75% annually, higher than passive index funds at 0.03, 0.10%. But here's the thing, if active management can generate even 2 to 3% extra return annually, that 0.75% is worth it. You're paying for expertise and stock selection. If you believe the fund manager can pick winners, the fee is justified. Objection 3. It's too volatile. Correct. It absolutely is. But volatility isn't the same as risk if you have a long time horizon. Volatility is the price you pay for potentially exponential returns. If you can't handle volatility, stick with boring index funds, but don't complain when you get boring index fund returns. Objection 4. Government regulation will kill these companies. Possible. Tech regulation is increasing. But historically, regulation creates winners and losers. It doesn't eliminate industries. The biggest companies in regulated industries like pharmaceuticals and banking are massive. Regulation often entrenches market leaders. Let me bring this all together with the key insights you need to remember. First, the next decade will be defined by the convergence of AI, biotechnology, clean energy, and financial innovation. These aren't separate trends, they're interconnected megaforces reshaping the global economy. Second, ETFs offer the optimal way to capture these trends with diversification, liquidity, and tax efficiency. You don't need to pick the single winning company, you can own them all. Third, ARKK specifically is positioned at the intersection of all major innovation platforms, making it a concentrated bet on disruption. High risk, high potential reward. Fourth, we're in a contrarian moment. After being crushed in 2022-2023, innovation stocks are hated. Valuations are reasonable. Technology continues advancing. This is when opportunities appear. Fifth, this is not for everyone. If you need certainty, safety, or near-term liquidity, this isn't your play. But if you're young, have a long-time horizon, and can handle volatility, this could be one of the defining positions of your investment career. If you found this analysis valuable, show some love by smashing that like button. It genuinely helps more people discover this content. And if you want to stay ahead of market trends, hit subscribe and ring that notification bell so you never miss our deep dives into the investments that matter. We're building a community of informed investors who think long-term and don't follow the herd. Join us. The next decade is going to be wild. Fortunes will be made, paradigms will shift, industries will be transformed. The only question is, will you be watching from the sidelines, or will you be positioned to capture the upside? Thanks for watching. Stay curious, stay informed, and I'll see you in the next one.